Welcome to this presentation on central banks. A central bank, or reserve bank, is a key financial institution in charge of overseeing and managing a country's money operations. They hold substantial authority over a nation's currency, money supply, and interest rates, playing a crucial role in maintaining economic stability. Central banks have multifaceted responsibilities. They ensure adequate funds in the economy and act as the lender of last resort, supplying funds to banks in emergencies to prevent bank runs or failures. Their overarching aim is to achieve the government's economic goals and maintain financial equilibrium. Central banks exert substantial influence over the banking system. They regulate and supervise commercial banks to ensure legal compliance and financial solidity. Their role extends to offering emergency funding to desperate banks, helping to stabilize the banking system and prevent widespread financial crises. A bank run occurs when many customers, gripped by panic, rush to withdraw their money at the same time. This sudden withdrawal of huge sums of money can put significant financial strain on the bank. A bank failure happens when a bank becomes insolvent. That is, it cannot pay its debts. Central banks step in to prevent such events by monitoring banks and providing necessary financial support, ensuring the overall health of the banking sector. Central banks control the money supply to steer the economy. When the economy faces challenges, they may inject money, increasing the money supply to stimulate growth. They use tools like reserve requirements, open market operations, and the discount rate to manage the money supply effectively. Three main tools central banks use are the reserve requirement, open market operations, and the discount rate. Adjusting these tools allows central banks to influence how much money is in the economy, affecting lending and borrowing, and ultimately impacting economic growth and stability. The reserve requirement determines how much money banks can create with each dollar of reserve. By increasing the reserve requirement, central banks can reduce the money that banks can loan out, leading to a decline in the money supply. If they reduce the reserve requirement, the opposite happens. The money supply rises. Through open market operations, buying back government securities increases money in circulation. Adjusting the discount rate, or the interest rate on loans made by the central bank to commercial banks, influences the borrowing activities of banks and the money in circulation. A rise in the discount rate results in a decline in borrowing activities. A cut in the discount rate, conversely, boosts borrowing activities. In recent years, central banks have gained more independence from political control. Although still accountable to the government, they often have the authority to set their own targets and goals. This autonomy allows central banks to make unbiased decisions and focus on long-term economic stability rather than short-term political gains. In conclusion, central banks hold a pivotal role in managing and stabilizing a country's economy. By controlling the money supply, ensuring the health of the banking system, and setting clear economic goals, central banks contribute significantly to a nation's financial and economic well-being.